Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Cleveland Fed names former Goldman partner as president. Beth Hammack will be starting on August 21st. The incoming Cleveland Fed chief left Goldman Sachs in early of 2024.
So following up on that news for the Cleveland Fed, let's check in with Steve Matthews, Federal Reserve Reporter for Bloomberg News, joining us from Atlanta via Zoom. Steve, tell us about the news coming out of the Cleveland Fed.
So Beth Hammack is the recently was the co-head of global financing at Goldman Sachs, and she will be joining the Cleveland Fed as president in August, and she will be a voter this year, so it should be interesting. The Cleveland Fed has been kind of a leader among the 12 Fed banks in diversity. The first woman ever to head a Fed bank was at the Cleveland Fed. This is the fourth woman following, she replaces Loretta Mester, who was very much a force to be reckoned with on the Fed, and generally viewed as moderately hawkish. So we don't really know how Hammack is going to be, but it's also of note, and this will probably cause some discussion, possibly even by Congress. But this will be the third significant Fed hire from Wall Street. I mean, the St. Louis Fed just hired someone who from a hedge fund background. And of course, Neil Kashkari at one point worked at PIMCO. So it's interesting. The Fed obviously cares a lot about transmission of monetary policy, and understanding the nuts and bolts of Wall Street and regulation is really important. So this is a kind of a deep Wall Street background and understanding that she'll bring to the job.
Yeah, talk a little bit more about her resume, because not only Goldman, but she was also part of TBAC, right? The Treasury. What's my acronym here on this one? But I know that because I interviewed her talking about that. The Treasury Borrowing Advisory Committee. What is that? Like, how did she play a role in that?
That's right. I mean, it's essentially kind of a committee that deals with the Treasury Department and advising them. And she led that committee, and she was considered at Goldman as a leading candidate to be chief financial officer. She didn't get that job a few years ago, but she's had like a ton of different high-ranking positions at Goldman. And, certainly her experience dealing with regulators and understanding the regulatory background, that's going to be helpful at the Fed, which is a big bank regulator, including of Goldman.
Steve,
although she presumably would not be involved.
Right.
That's done by the New York Fed.
It just enlighten me, Steve. Is there any approval process here for this appointment, or is it no?
There is. I mean, the way the process works, they started a nationwide search last November. It involved the 6 directors, other than the bankers. The bankers who are directors of the Cleveland Fed are not involved. And then after they select a candidate, that candidate then has to be interviewed by the Board of Governors. And right now, Chris Waller is the governor who used to work for the St. Louis Fed and was appointed by Trump. He kind of leads the effort to screen presidents, but the board will vote on them, and they have to be approved by the Fed's board of directors, board of governors.
We've interviewed her on TV before when she was still at Goldman. She's such a firecracker. She's only 52.
Right.
Such a firecracker.
Right.
Walk us through sort of the District of Cleveland, like not the actual city, but in terms of the Fed, like how is that region doing?
The Cleveland region has always been kind of, it's a Rust Belt Belt region, Ohio, it's not one of the, each of the 12 regions are different, but this is a region that's more suffering and more struggling. And there are a lot of issues like with education and with not having the best jobs, and so it's a tough district.
Steve, I mean, she's a Wall Streeter, as you mentioned before, and there's been a couple of those in the past. Does that get pushed back anywhere? I mean, but I'm not sure who you would rather have than somebody from financial services at a Federal Reserve job, but where do they typically come from?
There has been some pushback. I mean, there are groups that are kind of more some of the liberal think tanks, and I think Elizabeth Warren has occasionally weighed in, the senator, in opposition of there being too many, Goldman and Wall Street alums. I mean, there have been quite a few. The former head of the New York Fed was a Goldman economist, and Robert Kaplan, who was with the Dallas Fed, was a Goldman, alum. So it's like sometimes there has been criticism that the Fed is like too close to Wall Street, but as you say, I mean that the flip side is you really need to understand the nuts and bolts if you're going to regulate it, if you're going to understand monetary policy transmission and all the ins and outs of QE and QT and those kind of things.
I mean, we know that Mester has been on the more hawkish side of the Fed. Best guess, and I know you said we don't know, so okay, best guess as to where Beth Hammack would lie.
But best guess is that she would be hawkish, and that's just because there seems to have been those presidents that have come in from Wall Street have tended to lean a little bit hawkish, and the Cleveland Fed over the years has leaned hawkish, and sometimes the directors of the Fed banks like the tradition. So it's like, for example, Kansas City has almost always leaned hawkish, and it's like you go back year after year after year, and whoever the president is, they're leading hawk, and that's been true of Cleveland as well. So it's like if you were betting, the odds would be well over 50% that she's going to be hawkish.
Very good. Steve Matthews, thank you so much. We appreciate that. Steve Matthews, Federal Reserve Reporter for Bloomberg News. And again, the Federal Reserve Bank of Cleveland appointed Beth Hammack, a Goldman Sachs Group veteran, as its next president. Hammack, who was most recently co-head of global financing at the Wall Street heavyweight, has more than 3 decades of experience in finance, capital markets, and risk management. She replaced Loretta Mester, who was stepping down June 30th after a decade in the post.
It's interesting because we've also reported a lot about the revolving door of women executives over at Goldman Sachs and sort of the why behind it and kind of where they wind up going. And now we know where one of them goes, to the Fed.
Yep, very cool.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's pivot to, energy?
There's some stuff.
Can you take the ball here? Because I have no idea what's going on.
Okay, so the latest. So yesterday we got the news that the Hess shareholders approved the deal with Chevron. There's still an Exxon situation there with the right of first refusal for an asset in Guyana. However, today we get another big deal. ConocoPhillips buying Marathon Oil for $22.5 billion, and that's including about $4 billion in debt. I'm getting a slew of analyst notes coming out. It's quite interesting because the question seems to be, does this make Conoco bigger or better? And I think that's a really interesting point because a lot of the M&A that we've seen has been making them better and bigger, and you have to wonder what the distinction is here with Conoco. So Vincent Piazza is Bloomberg Intelligence Senior Equity Research Analyst for oil and gas. He joins us. What do you think, bigger or better?
I think a little bit of both. It makes them better in certain basins because it does consolidate an opportunity set in places like the Delaware, the Bakken, and even the Eagle Ford, but it does extend the franchise into other areas that probably dilutes some of that narrative. The narrative has been consolidate, streamline, leverage to what you do best. We saw that in the Permian. We saw that for natural gas as well, with Southwestern and Chesapeake likely getting together. So in this case, you have some pieces of that marathon pie that don't really may not work as well within the broader Conoco platform, but that's an opportunity set to divest some of those pieces and really concentrate around Texas and the Bakken. But the Bakken itself is maturing as well. What you're really getting here is a ton of free cash flow as well. This is consistent with the formula, the theme, the narrative that we've heard and seen in the past. The acquirer using a slightly higher multiple to do an all-stock transaction, buy the company, bring those assets, those cash flow generating assets into the platform, lower the spend, generate that free cash flow, be able to boost the ordinary dividend and also the supplemental dividend, and support the stock by buying back shares as well. And in this case, financially, engineering-wise, it actually works out.
Right. Hey, Vince, I noticed there's a lot of M&A stuff going on in your energy world here. Do the regulators care about this stuff?
Oh yeah, they definitely do care. They will take a look at this. We wrote about this earlier this morning. This will take they will take a serious look at this. They will increase the scrutiny of all of these deals. I know that they're looking to close this by 4Q 2024. I think that's kind of tight. We have seen other deals close, Exxon closing Pioneer around that same time as the projected closing date as well. But there are other deals that may be prolonged, and this will be a rather large entity. It's going to be roughly 2.2 million barrels a day of production. Mm-hmm. So it will get scrutiny. It will get scrutiny more broadly. But in general, it's really not sizable in those particular basins that they are consolidating.
So to that point, do we see another bidder come in? So Bloomberg has reported that Devon was also interested in Marathon Oil. Do you think we see this happening now?
Well, they were looking at it. When you work out the numbers, it would have been kind of difficult to make it work. Okay. But the accretion here, Conoco Marathon, probably works out best. Actually works out better for Marathon holders. It's interesting because within the first 3 years of the deal, Conoco suggests that they'll buy back as much stock as the entire market cap of Marathon, including a boosted dividend for legacy Conoco holders and new holders from the Marathon purchase.
It's an all-stock deal, which, all right, I get my M&A fee, Alix, but I don't get to do the high-yield piece, which chooses my fees here, so I'm not really happy with an all-stock deal
it's Evercore, I think, that led Conoco on this one.
Did it? Okay.
Yeah.
I looked at MA Go. They did not have the M&A advisors there. I'm a little bit slow on that. Vince, are we going to see more of this? I mean, are we going to be talking to you more about M&A in your space?
Yeah, we've seen it across the Permian. We've seen it in natural gas as well. Haven't seen it as much in natural gas, but I think that'll pick up as well, as we're seeing a bid here for Henry Hub and various prices across the regions. When you have a commodity that is in the crosshairs, or an industry that is in the crosshairs of both civic and political leaders, the one way to survive is to consolidate and get bigger if you're not able to grow organically.
Who's still next on what to buy? Endeavor was one that's being taken out. There were a few others also. Uborn, which I'm not that familiar with. It's a private company, but that was kind of on the list. Who are the top targets now?
Well, I think you've mentioned the two top private entities in the Permian. Look, you can also see still more consolidation across Appalachia and also the Haynesville. There's some fragmented spaces there that can be consolidated. Chesapeake and Southwestern likely gets done. Devon was looking at Marathon. They could still do something in the industry as well, trying to block up more space for their Permian platform.
Right.
You have a lot of smaller players across the basin that still need to address their size. Again, this is about consolidating to grow inorganically, right. Because the big players, they've blocked up the takeaway, they've blocked up the services at reasonable prices. So it becomes more difficult for some of the smaller players across gas and oil.
All right, Vince, thanks so much for joining us. Really appreciate getting your insight and analysis there. Vince Piazza, Senior Equity Research Analyst, covering all the energy space for Bloomberg Intelligence. Again, Conoco bidding for Marathon Oil, another M&A trade in the oil patch. Good to be an energy M&A banker.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I'm Alix alongside Paul Sweeney and John Tucker. This is Bloomberg Intelligence Radio. We bring you all the top news in economics and finance and business through our lens of our Bloomberg Intelligence analysts. They cover 2,000 companies and 130 industries worldwide. And also once an hour, we go outside of Bloomberg Intelligence and get the read on the market. And today we're going to Katerina Simonetti, Senior Vice President, Private Wealth Advisor, Morgan Stanley Private Wealth Management. She is joining us from Philadelphia. So we're looking at a market here, and the excuse, we're seeing a sell-off because the takedown in the 2- and 5-year supply yesterday in the bond market was really tepid, and we have the 7-year today. And all of a sudden, everyone's worried about, is there enough demand for treasuries? And then that's why stocks are selling off. Is that narrative right?
Alix, there's such a crossfire of news coming at us lately. Investors, are not sure which side they're on. On one day they're worried about the Fed action, another day they're excited about the market. And what we are trying to keep them focused on is that the long-term narrative should be the balance and the correct approach that should align with their goals. That the balance of their portfolios should not really be dependent on what is happening day to day with the treasury market, or whether Fed is going to have 2 rate cuts or 3 rate cuts or no cuts at all. It should be a longer term approach in making sure that the income and quality of their portfolios reflect their objectives of what they're trying to accomplish with their investments.
All right. So given that backdrop, Katerina, when you talk to a prospective client, how do you, and say they've got a 20+ year kind of investment horizon, is it 60-40 stocks, bonds, or do you have alternatives in there? What's kind of a model portfolio looking for you guys at Morgan Stanley these days?
Well, Paul, the benefit of the current environment is for the first time in many years, we're actually seeing good yields in the short-term investments. So our emergency funds, cash, should be earning adequate yield. I mean, this is just such an incredible opportunity. The second part of it is really the quality and health of the fixed income portfolio. This is the time to really improve that side, to make sure that we are as diversified with fixed income, both in treasuries, municipal, corporate bonds, high yield, preferreds, as we can be, because this is a unique opportunity to really align the portfolios for 20 years out and take advantage of the higher quality and higher interest rate environment. And last but not least is really the stock part of the portfolio. And the trap there is to fall into this excitement about AI and tech. And all of a sudden, we see portfolios that are lump-sided, that are not balanced in the way that they should be. And while we believe in AI and in the fact that it will increase profitability and will have a profound effect on the performance and really efficiency of all the sectors, even outside of technology, we think that portfolios need to remain balanced. So healthy profit taking, would be good here.
So going to the fixed income allocation, is it credit risk or is it duration risk that's most appealing to you?
Well, really both, Alix. When you look at the inverted yield curve, we see very clearly that going out, as much as we would love to, lock in these higher rates for, as long as possible, there is a time horizon there that is reasonable, which is, somewhere there in the middle. We are concerned about the duration risk, but most important factor, in our opinion, is really the quality. This is the time where, we don't have to compromise the quality of the fixed income portfolios in order to get higher yields.
How do you think about valuation here, Katerina, in the equity markets? So we've had obviously a big move in equity market prices off those October levels, and we've had good earnings certainly in that period as well. But have the earnings been enough to support kind of the valuations right here, do you think?
Well, there's a lot of pressure on earnings. The reality that we might be in the higher interest rate environment for longer is hitting both consumers, in their spending patterns, but also the profitability and the long-term outlook for the companies. We're seeing the slowdown in the labor market. We're seeing just general, the slowdown in the economy. And while with the stimulus, we think that the longer term outlook is actually quite positive, and we're positioning portfolios for quality, and we're looking at the sectors like industrials, consumer staples, financials, and you want to make sure that the portfolios are well represented in the dividend paying stocks. We still are, of course, concerned about the fact that this economy is very much showing the signs of the slowdown, and are trying to make sure that portfolios are protected.
So so what is protection right now within the equity market?
Alix, it's emphasis on quality, and it always has been the case, but more so now. And what is unique about this market is the companies with very clear competitive positioning are somewhat evident. This is definitely a stock picker's market. This is where owning the portfolio of good quality names that are showing healthy balance sheets and are positioned well to improve and continue to grow the earnings, and really the support the valuations and that we're seeing right now versus the broad index. This is the time to definitely own these very individually crafted portfolios and pick individual names.
Hey, Katerina, it's an election year, and likely there'll be a lot of noise around that in the second half of the year here. When you're actually, question to you, do your clients call you up and say, what do I do for my portfolio in an election year? Is that a concern for your clients?
Oh, absolutely. And the questions that we get usually is how one or another outcome of the election would affect their portfolios, and should we do anything at all to really position the portfolios for the outcome of the election. And of course, our crystal ball is a little murky these days, and it's so hard to predict. And we tell the investors that they really should keep their eye on the price, that the balance and allocation of their portfolios should not be dependent on who is in the White House or, the really even the Fed action. It should be on the current economic environment. They should be well balanced. The asset allocation and diversification is really the key, to the long-term outlook, but also rebalancing, it's just staying with that balance, right? Making sure that we take advantage of the buying opportunities in the market, that we take some growth off the table that makes sense, and refocus it in the sectors that have not had the run yet, which is really something that is going to ensure the longer term performance of the portfolios.
Katerina, thank you so much for joining us. Katerina Simonetti, Senior Vice President in Private Wealth Management at Morgan Stanley.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Another story that we're obviously following that's really important is the latest in President Donald Trump's hush money trial. I got to tell you, the traffic coming into work the last couple of days have been terrible, and I don't know if that's because of the trial, but it's something I'm keeping my eye on.
And Midtown's a little bit dicey because I guess he's staying at Trump Tower, as you probably would.
Yes, this makes sense.
There, so I had to go to a store near there yesterday. It was kind of a little congested.
This is important stuff to know. We also want to know, what happens now. So we have closing arguments, what's going on with the jury, with the judge, in terms of timing as well. Joining us in the studio is David Voreacos. He's a legal reporter for Bloomberg News. What is the TikTok? What happens now?
The judge has been instructing the jury this morning on how to apply the law to the evidence. This was after more than 8 hours of closing arguments yesterday. Once the judge finishes his instructions, the jury will begin to deliberate on 34 felony counts against Donald Trump, and at some point in the near future, we'll have a verdict. Any thought as to how long this type of trial may take in terms of deliberations? Is it measured in days or longer? Or? It's anyone's guess, okay. Really. I would think it would be at least a couple of days, but there's no way to know for sure. There's a lot of evidence to go through. There's some fairly complicated law to apply to that evidence. It seems to have been quite a serious jury who's been paying close attention. They have 5 weeks of testimony, 22 witnesses to review, and an awful lot of exhibits.
What has the judge told the jury about things today?
The judge has told them essentially to put aside any political beliefs they have. He's also instructed them on how election law applies to this case, and that they can have any of the evidence read back to them or played back to them. He's essentially setting them up so that they can enter this little world where it's just them, and they make a rational decision on guilt or innocence on the 34 counts.
Would these normally be felony counts?
These counts of falsifying business records under New York law would normally be misdemeanors, but are elevated to felonies if the jury decides that Trump intended to violate either state or federal election law or state tax law. He doesn't actually have to have accomplished that, only that he intended to do that. So a lot of this is going to turn on Donald Trump's intent, and the instruction is going to focus on how jurors can decide Trump's intent.
So can he be found guilty or not guilty on some counts and some different on the other counts, or is it all kind of one big package?
He definitely could be found guilty on some counts, but not others. If the jury buys the prosecution's theory, which was that these repayments was to conceal damaging personal information that would have influenced the 2016 election, it's more likely than not that he would be convicted on all the counts. But one way the jury might split the difference is that there are 11 checks involved. 2 of them were signed by his former CFO, Alan Weisselberg, and by one of his 2 sons. The other 9 were signed by Trump when he was president in 2017. And they may say, well, we'll convict on these 9 counts because Donald Trump himself signed the checks. There's also counts involving invoices from Michael Cohen and vouchers that were in the Trump Organization system. It may be that they conclude that Trump didn't know about those invoices or vouchers, but he knew about the checks that he signed.
Wait, how did things go yesterday? How were closing arguments and how that kind of sets them up?
It was a pretty dramatic day. It went on for a long time. It started at 9:30 and didn't end until 8 p.m. last night. And it was kind of grueling to follow it all, but it was an excellent overview. I would say both sides were able to put their best foot forward and make the best arguments they had.
Is there an informed opinion out there in the legal world as how this might go in terms of a decision here?
Nonpartisan informed legal opinion?
Yeah. Is there any kind of consensus in your reporting that you guys have found?
I would say that generally legal analysts believe the case against Trump is strong, but it's hard to know whether there are supporters on the jury for an acquittal. And so I think generally the consensus is that a conviction is more likely than an acquittal, but that a hung jury is a real possibility.
And then I guess appeals will happen.
But is jail time a real possibility with this judge? I know he really takes seriously, it seems, white-collar convictions, right?
This judge, Juan Merchan, threatened a couple of times, and the second time more seriously, to jail Donald Trump if he continued to violate a gag order against him, threatening witnesses or members of the prosecution staff. But he never actually put Trump in jail, and so that's the real open question, that if he were convicted, would he actually sentence Trump to jail? He faces up to 4 years in prison if convicted.
Wow. A lot to unpack on that one. All right, we really appreciate it. Thank you very much. I know it's a lot to get through. David Voreacos, a Bloomberg Legal Reporter, joining us.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, in the fixed income markets, folks, I don't think I need to be a hero here. I can get the 2-year Treasury and get right around 5%. That's not bad, folks. I mean, you think about where we were the last 10, 15 years. That's a living, I think. But maybe our next guest will get me to be a little bit more adventurous and take some credit risk out there. Jerry Cudzil, he's a group managing director and Generalist portfolio manager at TCW. Boy, he's been stuck in the bond market his entire career. Buy side, sell side, no creativity whatsoever, no equities. Jerry, you're like Mr. Bond person out there. So I guess TCW is a great place to be because you guys are a serious bond shop out there. So Jerry, how about my 5% on the 2-year Treasury? Is that such a bad thing?
It's not a bad thing. There's something for everybody, as you mentioned. I mean, 5% on a 2-year Treasury risk free in a world where a couple of years ago you would have reached for 1.5% in a 10-year note. That's not so bad. I think we would agree. I think we would probably tell you not a bad time to think about moving out the curve a little bit, 3 and 5 year, but earning 5% over 2 years for risk-free rate, that's pretty attractive.
What do you make of what's going on right now, though? Because the excuse is like, ooh, that 2 and the 5 year yesterday was not great. We get the 7-year, $44 billion coming today at 1. That might not be that great, and the markets are trading heavy because of that. Does that not hold water for you?
No, it might. I think, look, technicals will be what they'll be in the short term, and that'll maybe create a slightly better entry point, for investors. I think what we would, Alix, what we would say, as you think about the real question is, okay, if you're in a higher for longer environment, what might that mean essentially kind of overall? I mean, whether you put a little bit of pressure and you can buy the 2-year note at 5% or 4.95, or rates move five bips higher, that's not really the story. The story is going to be, when's the Fed going to move? What's the pace of the move, and what's that going to mean for kind of for risk kind of broadly?
So Jerry, what is the TCW call on the Fed?
Well, our view is that simply inflation is moving in the right direction. I think it doesn't ever come down in a straight line. I think as we see it, I think simply stated, and we as we look at it, we think that the jobs market, the employment market, is just it's softening, real time. Whether you think that's going to roll over and create a recession, and we think, why don't we focus on that? What does that ultimately mean? Is that ultimately all inflation will need to be sustained by wages, and real wages are kind of scratching positive still at the moment. But you have a real stretched consumer, and ultimately our view is that rates are going to come down. Looks like that we're in a little bit of a higher for longer environment. It looks like it might get extended out a little bit, but ultimately once the Fed goes, they're going to have to go at a pace that's faster than what's priced into the market today.
So when you're looking at the curve, for example, how much duration do you want to take on? Like, do you like fixed income for its yield or for its price?
We would say that there's probably a little bit. It's a little bit of a nuanced answer. We like going out a little bit into the kind of intermediate part of the curve. It's maybe as a bond guy, that's exciting. Paul, to mention in my career, the bond market, my whole career. Maybe not as an equity person. I'd say extending out the curve into kind of 10 and 30 year duration. We're not as not as excited about that. But I think in 2 and 5 year, we think you're supposed to be moving out the curve, at least into the intermediate part of the curve. And that could actually be a real, that could give you kind of income today, and then also give you a little bit of price appreciation to the extent that the curve does normalize, does begin to steepen out, and you do get to see some more cuts that are priced into the marketplace.
Alix, when I was a sell-side analyst, I'd go to TCW all the time because they're like a really big account. And you have to get their I vote. One day, I got off the elevator on the wrong floor with all the bond people. Is a disaster. Convexity, duration.
Oh God! And you ran.
Oh,
you feared for your life in the jargon world.
I had to get back to the equity floor. We could talk about PEs and stuff like that. Jerry, do I take credit risk here, or people like you were telling me that the spreads are so tight, I'm really not getting paid for it. How do you think about credit and opportunities there?
Yeah, that's really the question. The question is, why is there all this demand for credit, right? You have private credit, you have the public markets issuance almost at all-time highs in just about every segment of the marketplace, investment grade, high yield. And so the question is, technicals are really strong. But we think what's driving the interest in credit is really the risk-free rate. It's not the 80 basis points you're receiving in investment grade credit. It's not the 300 basis points you're receiving in high yield credit. Actually, those historically look really tight. Doesn't mean they can't get tighter, doesn't mean they can't sit here for quite some time, but they don't look attractive from a total return perspective. As a matter of fact, prospective returns, when you consider starting spreads today, they get challenged over time. So we don't think you're supposed to be reaching out the risk spectrum in credit broadly. We do think there are plenty of opportunities. It's just, if you're trying to say broadly, what are you supposed to do? We don't think moving out the risk spectrum, into riskier parts of the credit markets. We don't think you're being compensated for that.
I feel like I'm going to ask a verboten question, but typically when I'm looking at the risk-free rate, that's the 10-year. Is the 10-year still the risk-free rate?
Yeah, look, I think you have to think about the entire curve at this point, and it's an interesting question given the pronounced and prolonged inversion of the curve and what that has meant or really hasn't meant for the economy, and whether or not this inflation signal, this recession signal is dead in terms of the inverted curve, or whether or not R star is higher. Terminal rate, and is all that. So where are you supposed to look? We still think that's the right place to look, Alix. But it's, I think you definitely have to consider all parts of the curve, and there's some plumbing changes that have happened historically in the marketplace that we don't need to get into. But what we would say is, you probably need to look at the whole curve. Probably got to look a little bit more holistically today.
All right, Jerry, thanks so much for joining us. Really appreciate it, as always. Jerry Cudzil, Group Managing Director and Generalist PM over there at TCW, the good folks in Los Angeles.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.